What's going on, Trader Gang? It's your host, Colton Lives Bullish here, and you definitely want to stick around because I'm giving y'all another insight to my confirmation checklist here. Today, we're going to be adding the Fibonacci retracement inside of the checklist that I have out here free on YouTube for you guys. So if you haven't already checked out the previous videos, I would do that. But again, today we're going to dive into Fibonacci retracements and how they can help you particularly find entries and stop losses and target points inside of the market. Now, before we get into the technical side, there's a lot of different ways. I would say a couple different ways that you could actually use the Fibonacci retracement tool. And, again, the cool thing about what we do here on this channel is this really does fall about this seventh confirmation that I have for myself, because the Fibonacci retracement just so happens to magically line up after we've seen all these other institutional things play out on the charts. So again, there's some traders that have very good success with this when they use it as a first confirmation, third confirmation, whatever it may be, taking it from a single high to a single low. But I'm going to show you guys how we could go ahead and walk through all the other confirmations that we have and just have that Fibonacci retracement there on the back end to give us even more confidence getting into our positions. Now, the last thing before we get into the technicals, you got to make sure that you like and subscribe to this video, subscribe to this channel, because that's how YouTube goes ahead and pushes out this to other individuals that need this information just as much as you sitting here watching this video. That is the currency on YouTube. So make sure to smash the like button and let's get into the technical side. All right, so now we're going to go over some of the basics leading up to how we are going to use the Fibonacci retracement. We're going to go into what exactly a Fibonacci retracement is, and then we're going to go over a lot of examples as to how these play out on the candlestick charts and how we even used it this week to catch certain moves that were talked about in the free Telegram trading channel. So again, number one, we always want to understand where we are at in market structure, right? Based on Wyckoff, are we in a mark down? Are we in an accumulation? Are we in a mark up? Are we in a distribution? Are we in a mark down? And then number two, trend analysis. This plays along with market structure, just understanding whether you're trending down, trending up, or trending sideways. So number one and number two should be a given if you study Wyckoff on a consistent basis, right? Number three, we want to look for that liquidity. We want to look for money to build up in phase B, right? That's what this is, right? We're consolidating, we're creating liquidity to the upside and to the downside. Number four, we look for those institutional candles, those candles that go and stop out the many to go ahead and break of structure. So that's what we see here, right? You normally have an institutional candle drive down below the liquidity, drive up, which is a break of structure above old highs. And now after that institutional candle, what you get is an imbalance because that candle moves so fast. It's an imbalance of price. It's insufficient price action. So what the markets like to do is they like to come back and reprice, rebalance, whatever terms you want to use, into those areas to go ahead and continue the trend. Now, time of day is something I threw there in the middle between Fibonacci and imbalance, just to help you guys kind of break down smaller areas and smaller times during the day where you could actually enter the markets, the most liquid times of the day, whether it's core London, core New York. But right now, this is where it leads us up to the Fibonacci retracement and how we use it. So again, as we see, that institutional candle drives up, it's going to leave us an imbalance. We're going to drive back down into that imbalance and continue our market up. And then the same thing happens to the upside in distribution. We drive down in a break of structure. We drive down in a break of structure. We retrace back up. And we're going to show how you use the Fibonacci retracement tool here into the imbalance. We drive down, again, showing it here on the Elliott wave. I have a couple different examples here, right? 0 to 1, 1 to 2, right? Institutional candle up, 2 to 3, break of structure of number 1. And as we pull back up, we're going to pull up above liquidity, pull up into an imbalance. And a lot of the time, what we can do here is take a Fibonacci retracement tool, right? From swing high to swing low, right? We have the 1 up here at swing high, and we bring the 0 down here to swing low. And now this is where we're going to look for our retracement. Now, as you can see, and I'm going to go over these numbers, a little bit more in depth, just stay with me. A lot of the times these retracements above the liquidity into the imbalance, into the institutional candles are going to line up with these Fibonacci levels. So again, right, I'm just showing you guys how all other 5 to 6 confirmations that we've talked about on this channel are going to lead up to show us how we could actually use this Fibonacci retracement. So I'm going to go ahead and delete this little markup down here. And this is what we're going to walk through, right? So again, mark down, institutional candle to the downside. We drive up for a break of structure. Now, again, what do you guys know? That this is a low, and then we go ahead and make a new high, correct? So we have a low and we have a high. Now, this is where you're going to want to go ahead and pull out your Fibonacci tool. You want to wait for that break of structure, right? Low, high, we've made a lower low. Now we've made a higher high. So what are we going to look for now? We want to look for an area to make a higher low. Now that higher low, a lot of the time, right, could line up with that imbalance in institutional candle. What hangs out above the imbalance in institutional candles? Pools of money. So as they make this new high and they pull back down, they're going to consolidate a little bit, get in those early buyers, get in some of those sellers. Now, as they drive price down into that imbalance in institutional candle, right? All these things we've already talked about on this channel, this is exactly where some of these Fibonacci retracements fall into place. So what we want to do is go ahead and grab our Fibonacci tool. It'll be over here, right? In these long and short position, or I'm sorry, it's going to be over here inside of this second column. You're going to drive down, you're going to click on the Fibonacci tool. Now, what you're going to do is you're going to pull it out from the low and you're going to bring it all the way to the swing high. All right. So we have 1 from the low all the way to 0 to the swing high. Now, let me explain what a Fibonacci tool actually is, right? So I took a couple screenshots here, right? You know, it's a method for technical analysis determining certain support and resistance levels, right? It's based on the idea that a market will retrace a predictable portion of a move and then continue in its original direction. And that's the key here. Continue in its original direction. You only want to use these after we've seen these other confirmations and we know we want to trend in a certain way. You just don't want to be putting Fibonacci tools all over the place because you're going to get confused whether you're in a markup or a markdown. So wait for these confirmations. Now, look how beautifully this is going to play out most of the time. Again, I'm going to show you guys how they do this on the candlesticks day in and day out, whether it's Asian session, whether it's London session, whether it's New York session, right? So low to high, what do? They pull back down. Now from this low to this high, the halfway point, right? If I were to mark up where the halfway point is, just let me go ahead and grab that imbalance tool just so you guys can see, you know, exactly where this is if it doesn't quite make sense to you yet. And if you're already to an advanced section, just follow along with me, right? This dotted blue line is 50% of this low and this high, and that's where this 50% of the Fibonacci tool is placed. So again, what they like to do a lot of the time is create money, create that liquidity right there on the 50% of the move. They got to pull back. They can't just move up forever. So they got to retrace back down. Now, we don't necessarily want to be taking entries at the 50% of the retracement. What we want to do is look for something a little bit deeper. This is called a discount of price. Why would you go to the store and buy something that's at a 30% discount when you know in the future it could be at a 70% discount, right? You want to wait. You know, 50% is great. You know, a lot of the times we will go out and spend that check on something that's 50% discount. But when it comes to trading, a lot of the time we're going to see that market retrace back into these deeper areas. So you see up here how I have lined up. We have a 61.8% retracement. We have a 70.5. We have a 79. We have an 88. And my core are these three blue ones. So as you guys know, I love using my markup lines as a blue, as you know, technically blue lines. So these are the areas that you want to be looking for, those deeper retracements. And this is where you're going to look for certain entries inside of the market. So watch them create the money on the 50%. A lot of the time, what will they do? They'll use an institutional candle to drive down 20, 30, 40, 50 pips into maybe a 61.8 retracement, 70.5, 79. So, you know, again, a lot of the times they may stop and retrace right here off that 61.8. And this is where, you know, a lot of those first entries could come. Right now, again, sometimes this is going to line up with the wick of that institutional candle. Maybe it lines up with the body of that institutional candle. All the structure is going to be a little bit different as you kind of walk through the charts. But what the key, you know, measure is here is understanding that these are pretty much three different entry points you can take. And now using maybe the 88 as a short-term stop loss and maybe the whole one, right, the previous low as, you know, your major overall stop loss, you know, this gives you a great area to be able to enter, have probable risk. And then as you see, we even have negative retracements using as target points. So as you see, as we go above that other structure, right, as we have maybe a, you know, another 2 to 3 push, the negative 27 is a great area to look for target point number 1. And then the negative 67, just like, right above 61.8 is going to be a nice area for target number 2. So again, I know I talk really fast. I hope you guys are able to follow along. We're going to do a lot of, examples as to how this played out on the charts, but this is pretty much the gist of it. You want to wait to see all these other confirmations, and you want to see, hey, swing high or swing low to swing high. Where do I want to be entering on my Fibonacci retracement? We didn't get any discounts below the 50%. Sometimes it'll be the 61. Sometimes they'll pull all the way down to that 79, right? And you're going to have to deal with whatever drawback this is, or you just wait for those deeper retracements. Now, again, that's all depending on your exact way of trading, whether you put your stop loss up underneath the 88, which is just a very deep 88% retracement of the entire move. Again, a lot of the time when we're talking Wyckoff, this, test of these deeper retracements, this pullback on the deeper retracements is going to be that test area, right? This is where that safest entry is, because you don't always want to be sniping the markets on just any accumulated low. We want to wait to show that evidence, pull back, imbalance, IT candle, right? As you guys can see, right, the 50%, if I were to take of this IT candle that I made up, is going to be right there around that 79. That's where you want to get in, minimal risk. You take that back up to the upside, and then, again, target points can either be, number 1, where you get to that equal break of structure, negative 27 could be target number 2, negative 67 target number 3. And then overall, I could even add something on here for you guys in here. If you kind of want this, you could take a screenshot, mark it up just like I do here. What we're going to do is we're going to do a negative 1. This is going to be a entire deviation from this low to this high, right? So again, this is going to be the same measure. If we went from low to high here, right, this is 109 pips. And then if we would go to 0 to 1 here, this is going to be another 109 pips. So this is the same exact move. So same measured move. So this could even be that final take profit point on 1. And let me go ahead and just make that green. Again, I don't normally keep this on there, but again, for you guys, if you kind of want to see how I line up all my Fibonacci tools, I hope you can screenshot that, and we'll go from there. So I hope that wasn't confusing. Let's go ahead and work this on some charts, some candlesticks, so maybe you guys could put a little bit better visual to all this. All right, now real quick, before we dive into some examples on the candlestick charts, I want to go over something because I haven't yet in this video. Again, I didn't make this up. I didn't learn this on my own. There were key mentors that really helped me learn this stuff throughout my trading journey, right? So again, my first 2 years, if you guys don't know, I come from retail world, and in the retail world, in a Fibonacci, you're using levels like a 23%, a 38%, and that 61.8 is really, really big in the retail world. So that's where a lot of this stuff, and when you guys, originally, if you've never used it before and you go click on that tool, you're going to have, stuff like that 23, that 38. I personally just don't use anything below that 50%. It's actually funny. I even have a tattoo of the Fibonacci retracement because this is found everywhere in nature, right? So it's like 0 to 1. This is the 61.8 type thing, but I'm not going to get into all that. That's just a funny thing that I have going on. But, again, I want to give credit to some of the individuals that taught me these things. Again, as you guys know, I was part of the IM Academy for 3 years. So shout out to Zach and Jordan and John Fibonacci. You can go find him on YouTube at John Fibonacci as a whole lesson course on the Fibonacci retracements and how he uses them, pretty similar to what I'm showing here. They're the ones that really, showed me that discount under the 50% and really helped me be able to take those deeper entries when it lined up with our certain Wyckoff stuff. Now, again, somebody else, if you're familiar with institutional trading here on YouTube, you're probably familiar with the Inner Circle Trader. He has some really in-depth content when it comes to how he positions himself with the Fibonacci retracement. He terms it OTE as an optimal trade entry. Again, I'm not going to sit here and teach exactly what he does there. That's where that 70.5 comes into play. Have I learned a lot from him? Yes, I have. But am I going to sit here and teach it verbatim, word for word? No, I'm not. So again, I just wanted to give you guys access to those individuals as well, because they've helped me get to this point as to where I'm at, even though I've never actually been an ICT student. Again, I'm sure myself, and a lot of other traders have been able to take certain things away from him. So I just wanted to put that out there. As you guys know, I'm super transparent with where I learned my stuff. I didn't make this up. I'm not going to say that I'm a self-made trader. Again, when it comes to the emotional side of things and the psychology side of things, it does come down to you. But when it comes to the technical side of things, you really need those key mentors in your life to help you get past those certain points. All right, so now it is time to go over some candlestick stuff. I'm going to give you guys a really great example as to how this played out last week in the markets, and then go over some other examples where, again, you're not always going to hit that 61 perfect. You're not always going to hit that 70% perfect. Sometimes it's going to go up and hit your stop loss because you're just not right on that trend analysis. But I'm going to show you guys how we could use this in our certain setups and how it's worked on some trades from last week and some trades from this week. So as you guys know, GBP USD is obviously the pair that I follow along. And again, everything that I've shown on the first 15 minutes of this video, this applies to any time frame. You could go do this stuff on the monthly, you could do it on the 4 hour, you could do it on the 5 minute, you can do it on the 1 minute. Again, the market's fractal, especially when it comes to institutional trading. It's going to happen on every single time frame. It just depends on what type of trader you are. Cool. So let's check this out. We're going to dive in right here. So again, market was trending up as we got to this 37 whole level in this 4 hour imbalance. We obviously saw some fast rejection. So this is exactly what we want to see, right? We have an institutional candle to the upside. We drive down very fast, right? We have a high, and let me just go ahead and just mark this stuff up for you, right? We have a high, and then we go ahead and make a low, right? Because this is what you want to identify before you pull out any Fibonacci retracement, right? Market structure has shifted down. We are in a downtrend. We created a new low. We broke, right? When I say break of structure, right? We broke like this structure, and we, again, very quickly broke any other support structure that we had up in here. So high to low. Now, what do we want to look for? We want to look for evidence of a lower high to go ahead and continue this market to the downside. Now, again, what did the market leave? And let me go ahead and just get my colors right here because I want to stay consistent on what I show you guys, right? What did we leave as we traded down into a new low, right? We left some areas of imbalance that we could go and play into. I'm just going to mark off that highest imbalance, and we'll go ahead and make that purple, right? There's our highest area of imbalance, right? If you were waiting for that institutional candle to be played, maybe you're looking at that open, maybe you're looking at the 50%, whatever it may be. Now, again, when you're going by the institutional candle, it is going to be deeper retracements, and that's why you won't always want to have your stop loss at that 88%, and I'm going to show you guys how that works here. But again, all the other five, we just went over 5 other confirmations, right? As the market, starts trading up, you're going to see that evidence of little liquidity pools being made. So now we have liquidity, we have imbalance, institutional candles, we had a break of structure. Right now, we can go ahead and pull out that Fibonacci tool. So what we're going to do is take it from swing high to swing low, right? One, you're going to bring it to swing low here. I'm going to pull it out right here. So again, swing high to swing low, market trades up. What do? We initially reject off that 50%, right? And then they go ahead that next hour, they come up here and they make that pool of money at that 61. Now, again, you guys can see that you can make money off that 61% retracement, right? It went for about 48, 50 pips. So I'm not downplaying anybody that, enters that 61 the first time or this, that, and the other. But what you want to do, right, is still wait for some deeper retracements. And overall, this made a pool of liquidity, pretty much our first pool of liquidity, or, you could say the second pool of liquidity if you're looking at this. Either way, there's going to be multiple on the way up. We didn't quite get into that higher imbalance or that institutional candle. So as you see here, right, this happened right at Asian session. So maybe you're not taking that. What happens here during core London? We trade up into that imbalance right here on that 70%. You see that initial engulfing down. They had to come up one more time, tap that 79%, which I believe overall got the open wick of that institutional candle. So, right, all of our confirmations, trade through the imbalance, trade above liquidity, trade into the open wick of that institutional candle, respecting that deep retracement of our 79%, right? If this is an entry at 36.68, your first stop loss could be, 36.84. So that's about a 15 pip stop, whatever it may be. If you want a little bit more than a 15 pip stop, you can go ahead with the 30 pip stop up above the high. As you see, that 88% lines up with that 50. So a lot of the time, if I'm taking entries within here, that 61 to that 79, I know that that's, a little bit earlier in the retracement. Now, again, the longer you wait means the opportunities of you missing the trade, but sometimes, again, it just depends on you. So if I enter here and use a stop here and it stops me out, I now have another chance to possibly enter on the 88 and then throw a stop again above the high, because again, as you see, that 88 lines up with the 50%. So again, it depends on you, but again, here, right, no candles closed above that 70.5, and that's where we got that fast rejection to the downside, right? Right in London, New York brought us all the way down. We equaled out the lows. We trended again, before we went out, and again, market traded lower. So as you see, right, first target point, first major overall target point was hit here, right? You see that initial rejection, and then we didn't quite get to that negative 67, but we did reach for it a little bit. So, this is a great example of showing how the market is going to play kind of those higher retracements. And that was something from last week. Now let's look at something, more from this week, right? So again, market trades down. And so this is what we already touched on in the price action video, right? Market opens, we trade down, right? What did we do? We had a low right during, New York, which was a previous imbalance. We trade up. Now here is where, it didn't give you that deep retracement, right? We had liquidity. We drove below it. We traded above, and we had that break of structure. Now, again, not always are we going to get that deep retracement into, a lower, which again, you can see we didn't have a lower 1 hour imbalance here. The imbalance is pretty much here. And again, if I were to pull that fib out from low to high, you're not always going to get those deeper retracements. It's not even always going to come to the 50%. This market had already grabbed enough here. We just wanted to continue up. Now, I am going to show you guys how, again, maybe you don't catch this Monday New York retracement, and then we have all this consolidation. You don't enter during Asian, you don't enter during London, but the price action study that we have came from this area during New York Tuesday morning. So that's what I'm going to show you guys here. And we got to go down to a smaller time frame to do this. And again, this is going to work on any time frame that you do. So again, market super fractal. We dive into here. Right, as we see, this is our 4:45 a.m. candle. So this is all New York until we get to that 10:15 area. Now, look at this. Just like we did it on the hour time frame, we're going to do the same thing here. This is a market high. This is a market low, right? So what do we do? And again, we're in an uptrending market now. So I'm not looking for that beautiful accumulation schematic where we have to have a break of structure, right? I have a high, I have a low, and we're making higher lows, right? We're making higher lows, and we can see that we're creating equal pools of money to the upside. And again, this was all talked about on the price action study. So watch how the Fibonacci retracement works here, right? If we were to go Fibonacci from low to Fibonacci high, look how we had all this beautiful respect, and you got to give the market time, right? It's not always going to reject away perfectly right away and just take off. You see here, I had to do it multiple times, right? No closes below that 70, no closes below that 70. And then overall, boom, right? What do? We trade right into all those target point areas. What am I looking for? So we trade right into all those target point areas. So again, there's a couple different ways that you can, trade the Fibonacci here, right? That was just the overall New York consolidation. You also have this, you could take it from this low to this high, right? So again, bring a market from this low to this high. As you see here, boom, right? We come down, tap that 70%, right? We come here, we never trade and close a candle below that 50, that last, little evidence to the 61 that we traded up to the upside. I still even want to show this on smaller time frames because this is exactly, the price action trade that we took this week. So let's pull back here, right? So again, market low, swing high. As the market trades back down, what happens right here at 9:50, right? That first 5-minute window that we like to get into the market, right? We have low to have high. So you can enter, right? Anywhere within here, right? 35.90 to 35.85, stops up under 35.80, right? That original 10 pip stop loss. What are you targeting, right? First target, boom, smashed. Second target, boom. Third target, right? To the T, 1-to-1, and then they show that fast rejection, consolidate for a little bit, and then continue up. So again, just certain stuff there. And then again, I know a lot of people took advantage of that distribution to end off the week. So we're going to go ahead and show that. And hopefully I'm not going too fast for you guys here, but I'm going to show you how this played out really nicely here. I'm just going to go ahead and clear it. Even if I have my higher time frame stuff up top, it's all irrelevant now. So boom, look, another beautiful Wyckoff distribution, right? Money right here. We had a candle drive above, and this is cleaner on smaller time frames. So we'll go over all of that, right? But we had that candle drive above. And then, overall, again, it took a while to kind of get this overall break of structure here. This was pretty much a money trend line. This is what we were targeting to the downside. But within here on smaller time frames, as you guys can see, high, low, lower high, right? And then we were just kind of making that equal money. And we kept making lower highs until we finally fell off. So check out what this looks like on the 15-minute time frame. Da 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 da. Right? So again, here's where the fractal market comes into play. Equal highs. We have our UTAD up thrust after distribution to the upside right now. Again, this was during this was during mid New York at 12:45. So maybe you're not worrying about this. We get that break of last support structure here, right? This was the last support. We break down below it. Now as we come trade back, right? This is our high. We just got a newfound low. So what are we going to do? We're going to take the Fibonacci tool, go from swing high to swing low, right? Swing high to swing low. What happens? We come up. What do we retrace into? We retrace into those key levels, those key discount areas, right? We come up. We close under the 70%. We come tap the 79. We trade back down. We come tap the 70 again. We trade back down. We come tap the 50 again. We trade back down. As you guys can see, right? Target 1 met by a wick, quick rejection. Target 2, right? Met by an institutional drive down before drive up. So again, just beautiful, beautiful ways to, calculate this market structure. As we're going on here, when it comes to where the market's at right now, it's kind of in a free fall, and we'll go over this on our Monday market overview. We'll get into this, but two clean plays there on GBP USD. Again, these were very beautiful setups on the indices that we had marked up in the chat before we actually got up here. Now, again, for S&P, right, this is something that had a little bit deeper retracement than that 70%, right? What do we have? We have market high, and then we made a market low. So what do we want to look for evidence? We want to look for a new lower high. So as we pull out a fib, we go from market high, we pull it down to market low right here. Now, as you guys can see, right, what did we do? All this liquidity being made, we come up, right? We initially reject off of all these prices, that 70, 79, but we did want to come up and tap the open of that institutional candle. Like I said, sometimes that institutional is going to be hiding up there at the 88. This doesn't always have to be your stop loss. It's just a, more shorter term stop loss. If you're taking entries down here, just trying to give you guys a couple different options, when you're taking these markets. And again, for a more long-term trader, if you're entering on the 61, maybe, you're taking that 20 pip risk here on the S&P, right? Again, for a more short-term trader, you're only looking for maybe like 3 to 5 pips. So that's why, again, this is more of an aggressive entry for a 20 pip stop. And this is more of a low risk entry of a 8 pip stop. But again, as you see, beautiful rejection off the 88, we trade down. And then what do, right? We meet that negative 27 and, first that 0 and then that negative 27 here on the charts. If we were to break all that down on a smaller time frame, right? Let me go ahead and just pull away what I just showed there. Let's dive into this on a smaller time frame and kind of just go over what happened within here, right? This is where kind of, more, optimal entries come into play. Swing high, right? Find your swing low, wait for any deep retracements. As you see, right? Where do we start getting rejection? All around that 70 to 61. We reached for that 88, almost got there. Market trends down, right? You could do a Fibonacci retracement there. Now, again, I'm not pulling this fib out unless I have all those other confirmations. Swing high, new swing low. What do we get? Those rejections off the 70, 61. We obviously trade down into all of our areas. I know I'm going pretty fast. I hope the candlesticks aren't confusing to you guys here. Again, we had similar setups with US 30 this week. Again, deeper retracements that we're talking here, right? If we were to pull out the fib, swing high to swing low, right? We did come trade through that 88%, but overall, really great smaller time frame distribution here as we knock down into the 15-minute, right? Let me go ahead and just delete that. We'll go ahead and delete the overall imbalance. We'll go ahead and delete that fib. But again, as you come in here, right, equal highs, we get this. So we just pull that fib high to, you know, let's see, this was probably that initial low. We come up, we're seeing all the rejection on the 70%. We trade down through everything. So let me go over some Forex stuff for you guys. Let's see what gold looked like. You know, and again, these trade entries, these Fibonacci retracements that you want to be looking for, you know, you want to be looking for these in New York session. You want to be looking for these in London session. So look at this, 4 a.m. London candle to the upside. We trade lower, right? We trade below this structure, right? With this wick. What happens right here at 8 o'clock, a core New York time? Let's see what kind of retracement we got here. Swing high to swing low. We didn't quite get the 50%. As you see, they left some imbalance here, but overall traded down. So, you know, again, nothing crazy there. Let's take a look at a couple other things. You know, again, I could go give you guys, you know, a bunch of hindsight, you know, back testing things. But, you know, again, this is for you to go do, right? I'm not going to give you all the sauce here, right? Swing high to swing low. What do we reject? 61 to 79%. Trade lower. I mean, I could pull through here and go over stuff. You know, again, there wasn't a whole lot that I found this week outside of GBP USD. But again, you know, again, look, we have equal highs, up candle, down move, right? Boom, high to low, all that rejection, we trade lower. You can do the same thing. You take your Fibonacci, right? Swing high to swing low, wait for those retracements back into these areas. And then again, what are you going to target? You want to target that other low, right? You want to target these other ones. And again, we obviously haven't got there yet, right? Because what do we do? The market's always reaccumulating, redistributing. So maybe we still got to come trade into this imbalance, maybe up to that original 61 to then bring the market lower. You know, but other than that, you know, again, this works for all markets. You know, I could pull up, you know, Bitcoin on the daily and, you know, we see really great, you know, Fibonacci retests on certain levels based on certain days. You know, here, waiting for a deeper retracement to happen, you know, from when we broke above 20K, right? We have this, you know, waiting for that 61, 70, 79% retracement. Look where they made liquidity on the 50%, right? We could go to the weekly and see the same thing happen before we even got that rocket ship up. Right? So just giving you guys certain examples here. So, you know, again, we'll just use this as that last found support. So we take market from that last found support, we take it up to its high, right? Where did we come retrace into, right? We initially come, you know, trade into the 50%. We're making a bunch of money on the 70%, showing rejection. We come trade through that 79, get close to the 88. We trade back up, Let's go see where we traded to up here, right? Again, you guys saw, you know, again, doubling the standard deviation here. That's where we found overall next resistance. And then again, just waiting for trades back down. But, you know, again, I hope that helped. You know, again, I know the back end of this video and the candlesticks may have got a little confusing for you guys. I know I'm kind of rushing through it. But overall, you know, again, I'm going to be working more Fibonacci stuff, you know, into the setups that I give you guys. And, you know, again, we've already had a lot on this video. Most people don't even make it. You know, most people only watch these videos for like an 8 to 10 minute average duration anyways. So those of you that do stick around, I greatly appreciate you. And hopefully you took the time to smash that like button. You know, but again, these are examples that we're going to continue to give out over and over and over again, right? I pointed out the great distribution that we had going on here, right? We had a high, a low that broke of structure. What kind of retracement do we get? High to low, right? 61, 70% retracement, retrade lower. What happens here? We have low to a high. What kind of retracement do we get? Right into a 61 to 79% structure. So again, I'm not showing you guys how you're exactly taking entries on these candlesticks. That's going to work out more as we do more price action and more studies. And I'll definitely make sure I get that on the Sunday and Monday market review for this week. So I appreciate you guys for tuning into this video. Again, like and subscribe to the channel if you want to see more content. I'm not sure when the next confirmation checklist video will come out. You know, if I want to really just give you guys another confirmation at the end of the day, you know, there's a lot of them. Like I don't have quarters theory on here, or whatnot. But, you know, again, I hope you guys enjoyed. Take this with a grain of salt. Go listen to your other mentors. I hope this helped clarify a couple other things for you guys. But let's have a great week. Let's have a great year in 2021 trading. I appreciate y'all. Hope you enjoy this confirmation checklist playlist. And let's have major success going into this year in the markets. Appreciate y'all.